Welcome to FX Options University. Join the industry's top trading professionals.
All right, and I'll be here in Abu Dhabi next week, actually teaching a Forex class, and I'm going to also be teaching an options class in Dubai too. So after that, I'll be moving on to teaching in Kansas City the first week of November, and then the middle of November, I'll be in our Fort Lauderdale location, and I'll be doing equities. So if you're interested in stopping in and saying hi, we'd love to have you. All right, so let's move on. Every time I do this webinar, I start with this slide because it doesn't change. The Online Trading Academy wants to teach people that come in, that become our students, how to trade using a combination of fundamental analysis and technical analysis. I hear a lot of people say one's better than the other. I personally believe that charts tell you what the asset is worth right now based on emotions of the traders that are trading. The fundamentals will absolutely tell you what the asset should be worth using various metrics, but emotions are something that have to be taken into consideration. And if you look at a chart, you'll be able to see a cycle, a repeatable cycle, depending on the asset that you're trading. And you'll kind of have an idea which party is in charge of the market, the bulls or the bears. So combining technicals to help you time your entries and using the fundamentals to tell you which assets are good to enter is a winning combination. Once a student actually has an understanding of what we call the core concepts of trading, then they have to write out a comprehensive trading plan. The plan describes their method of trading in advance, what they're going to do. If you're ever in a situation where you're under pressure, you know that you can't really think clearly, and so having a battle plan, something written out, is how you're going to control your emotions. It's going to make you much more successful than the person that has no plan, okay? So once you do a trading plan, you share that with your instructors and your education counselors, and we kind of help you to stay on track with that trading plan. And we try to help you to discover what type of trader you're going to be better being. So I've met a few people that were happy to be swing traders. I've met other people that were more active traders. Everybody has their own personality, and the trading plan helps you describe that too. Put it all together, and then you can start to treat trading as a business. So what do we consider to be core concepts of trading? We want to talk about markets that trend and markets that don't trend. So usually a market that has some kind of resistance or support is usually going to be a market that doesn't trend, and a market that actually goes beyond resistance and support will be a market that tends to trend. And we always talk about the different types of trends, secular trends, really long-term trends. Cyclical trends are a little bit shorter-term trends, and then every chart has a trend. So if you turn on the minute chart and you're interested in being a momentum trader or a swing trader, you can find an opportunity on that kind of chart too. We also want to take a minute to review the dollar since last October because it's pretty much gone through the cycle. Last October, it was pretty much where it's at right now. During the middle of the year, it rallied all the way back up to where the resistance was. And here we are back in October of 2010, and a lot of what we talked about last year is the exact same thing we're going to talk about this year. And this time we're going to go into a few specific strategies using the ISE FX options to take advantage of a trending market and to take advantage of a trading range market. So that is going to be the focus of today's presentation. And if I find there we go. So support, the textbook support, the definition that everybody talks about. People believe that something is undervalued, and they believe that it's a buying opportunity. And usually when they step up and they start to buy this asset, it prevents prices from going lower. So resistance is just the opposite. It's more of like a ceiling. It's a place where people that buy the asset believe it is now fairly valued or possibly overvalued. They begin to sell the asset. And when they begin to sell the asset, it prevents prices from rising. And a lot of people will talk about support and resistance using pivot points, moving averages, Fibonacci retracement levels, all good stuff. Anything that helps you to make a decision to make a trade is good. And trend lines will be used by people that are looking for trending markets. horizontal trend lines for range-bound markets. You can expect to see turning prices at weekly candle highs and lows, daily candle highs and lows. So a lot of things can be called support and resistance. The difference between the kind of support and resistance that everybody talks about and the kind of support and resistance that I was taught and many of our students are being taught at the Trading Academy is support and resistance created by institutional order flow, large orders from institutions, which most institutions can't buy and sell all day long. They're restricted to buying on the open of the day. They're restricted to selling on the open. They're restricted to buying on the close, or they're restricted to selling on the close. So by definition, they're going to place large orders in the market. And when they place those large orders into the market, this is what's going to represent true demand and true supply for whatever asset you happen to trade. So for example, we always tell the story that if a price is rallying and it's coming up to a resistance level in the Japanese yen at 95 cents, and I have 50,000 orders to sell of Japanese yen at 95 cents, and there's only 10,000 orders to buy, then as soon as that last buy order is filled and I've still got 40,000 sell orders, price must fall. The laws of supply and demand pretty much guarantee that once the last buyer buys and all you have left is sellers, price is probably going to retrace at least a little bit. Maybe not reverse, but at least those orders, until they're absorbed by the market, is going to stop prices from going either higher or lower. So once the person that taught me that said that this is how the markets work, pretty much everything else as far as support and resistance was okay, but tell me where the big orders to buy and sell are, and I'm pretty much going to use that information to make my trading decisions. Combine that now with trends, because once again, once these orders are absorbed and the market gets a chance to go higher, it's going to go higher and look for more sell orders. And that, by definition, is a trend. It'll break through this resistance, and it'll start to go higher. It'll start to make a series of higher highs and higher lows. If price comes down to an area where there's a lot of buy orders and you take out all the buy orders at that price level, then you're going to break through those lows and you're going to start a downtrend, which could be the start of a bear market. Now, my way of organizing information, and I should point out that I'm one of 60 instructors at Online Trading Academy. Each one of us has a different skill set when it comes to trading. Each one of us uses different things to determine how they make their decisions to trade. For me, it's always going to be about a weekly chart and looking for what I call the primary trend of the market. The primary trend being stage 2 uptrend or stage 4 decline. And if it's a stage 2 uptrend, I have specific rules. I either buy when price makes a new high in an uptrend, or I buy a pullback to some kind of support. If it's a downtrend, I'm shorting rallies into some kind of resistance, or I'm going to short when price makes a new low. So if the weekly chart is a primary uptrend, the daily chart will be an intermediate term trend, and in many times that could be an extended period of profit taking in the opposite direction. But again, if the weekly trend is up and it's a primary trend, the secondary trend is probably going to be a pullback opportunity. It could be a short-term shorting opportunity in a downtrend for a brief period of time. But I'm always expecting that primary trend to resume at some time, so the primary trend counts more than the intermediate term trend. Most traders, though, like to trade really, really short time frame trends. Today was a great example. We had an announcement from the Federal Reserve at 2:15 in the afternoon Eastern Time, and of course, that's going to bring volatility into the market. And that's the time of the day where a Forex trader normally would be doing something else with their lives because the market's pretty flat, but they want to make sure they're in front of the computer to take advantage of the volatility. And so the euro made a nice little recovery from a big sell-off for the last couple of days. So anybody that wanted to trade the shorter-term uptrend had a beautiful opportunity. If they were trading the short-term downtrend from the start of the day, well, they had an opportunity to do that too.
Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.